Good afternoon, everybody. Welcome to TraderMerlin Show for your Tuesday afternoon, the 18th of October. This show will be driven by listener questions. Ron up in Las Vegas sent in a really good comment about bonds, or just comments and questions about bonds. That's where we focus on today. Welcome, everybody, and I see we got Sandy, a new one here today, joining us. Welcome, Sandy. You say you hope to become a regular. As Yoda says, there is no try, only do. We'll see you regularly here. Hit that subscribe button so it'll notify you when we do the show live, which is every day pretty much at 2 p.m. Pacific time. All right, I'm going to go into the markets after I get through it because I wanted to talk a little bit about kind of what's driving the markets. And when I got started with this back in 1996, I was in college studying, the whole fundamental side of things and looking at earnings and how companies perform, and that's how I picked my investments. Unfortunately, I think my alma mater did a horrible job at preparing me for what really drives markets and understanding how markets work. But you live and you learn. I was actually hoping I could go back and help teach a class up at my alma mater, but they just don't want to teach the right things, apparently. So I'm going to go through kind of what drives markets today, just to start it off and give you guys a bit of a high-level approach to it and kind of what you want to be thinking about with different asset classes and how to look at them. Now, of course, if you watch this show on a regular basis, you know that we do look at most of the major asset classes, bonds, forex, and equity markets, and using those as tools to help guide our investment decisions. But some people may not know how that works, and I will show you how I present it today. So let me start off with the question that came in from Ron. It's kind of a long one here, so I'll read through it. And I know we've got people that listen to podcasts, so I'll do a theater of the mind for you all. I know you can't see the charts. I would encourage you to check out the YouTube channel so you can see the charts when we do them. But here is hey, Sheila, good to see you. Ron says, so my understanding is that the bond market controls the equity markets. Now, I'm going to stop right there because I have to say no. Nothing outright controls anything. There's an ebb and flow to markets where at some point you may get the feeling like equity markets are actually the one that's leading. And then all of a sudden that could change, and now you're looking at the forex markets are leading. So there'll be kind of a leapfrogging, if you will, of what is kind of pulling the market in a specific direction. Generally, yes, the bond market will be leading the equity market. So, but not always. All right. We are being told inflation is running rampant because rates are too low. Well, that's part of the story, Ron. The rates aren't running rampant because inflation isn't running wild because rates are too low. It's one of many effects that is causing inflation. So when you have rates down at zero, it means money is cheap. Again, companies can go borrow at a very low interest rate. So if I'm Apple or Microsoft or Facebook, I may want to look at expanding and growing my business. I'm going to go out and take loans at very low interest rates. So that helps grow the market. But then also what that in turn does is it does help cause inflation, but it's not just the low rates, right? It's a combination of many different things. But rising rates is meant to kill demand, not lower inflation. Correct. Yes. In this case, we are trying to choke out demand in the marketplace. So the more that we consume, everybody here, the more that you buy, the more inflation is going to rise. Now, I actually had a really cool video. If I can find it here, I'll play it for you live. It's by Visual Capitalist. I actually watched it earlier. It's about a 5-minute video, which would be weird for me to play a 5-minute video on the show. But I may try to do that for you guys to see the impact of a colossal increase of money supply, which is, again, one of the factors that has caused inflation, right? You've got really low interest rates in the bond markets. You've got a huge influx of new money coming into the markets, not just US dollars, but if you're over in Europe, you're using the euros and British pound. Because of that increase in printing of money, that has sparked the inflation in those countries as well. All right. So he says, so this will never work. So in order to lower inflation, doesn't the Federal Reserve or any central bank just need to contract the money supply, which would be to increase the capital reserve requirements for the banks, which is currently zero? Okay, so we're opening up a lot of different cans of worms here, Ron, but there's, and I mentioned this in the past, there's 3 major mechanisms that the Federal Reserve or the Fed can do to help fight inflation. Number 1 is what they're doing right now, which is raising rates, right? You raise the cost of capital, you slow down consumption, you slow down spending, which will hurt the economy. I don't think there's anybody here could argue that we are going to see the market slow down here because of this raise in interest rates. That's number one. Number two is they have to remove money supply. Now, I've shown the chart here in the past. I don't have it readily available, but over from 1950 to 2020, they increased the money supply by $1.5 trillion. Well, in the next 2 years, right? So 70 years, we did 1.5 trillion. In the next 2 years, we've increased it from 4 trillion to over 19. So we put in over $15 trillion. That is clearly going to create problems. So what you have to do is take some of that $19 trillion in M1 money supply and remove it. What they're doing now is they're selling bonds. Remember, they created money out of thin air, literally a digital entry. They created these dollars. They bought bonds with it from the Treasury Department and basically helped prop up the bond market. Okay, was that the right thing to do? I would say no in the long-term impact. Short-term, it was fine, but we're going to pay the piper down the road. So the removal of money supply is when the government's going to be, or the Fed's going to be selling these bonds, which they're doing right now, and taking that money and removing it from supply. That removes money supply, which should start to choke out demand. And the third one, which you mentioned, which is the reserve requirements. This is when you make a deposit to your bank, they are generally required, they're told by the Fed, how much of a customer's deposits they have to keep on hand. Right now, it's at zero. It's been zero since COVID hit back in February of 2020, and that should scare the hell out of everybody that's involved that has any money in a bank. That means the bank is not required to keep any of your money. It's all lent out, or could be all lent out. So if there's a run on the banks, we could have a huge problem. So those are the three mechanisms to help fight inflation. Now, we haven't seen them raise the reserve requirements. That will probably be the next piece. I'm kind of surprised they haven't done that, as I think you are as well, Ron, by your comments here. So there we go. So I'm halfway through this question, but that would be the last thing the Fed would want to do. So basically, the Fed does not want to get inflation under control. They want to continually inflate, or the debt market will implode on itself. So what's the best way to see what the bond market is doing minute by minute? Because we will know what the stock market will do. So I just like to look at the very basics of bonds. Let me bring up the charts here, and I've shown you this. We look at it every day on the show, pretty much. Down here at the bottom, I just keep the interest rate yields for the two that I'm mainly interested in, which is going to be the 10-year. And you can see that is just looking incredibly strong, back above 4% today. And then here's your 30-year, which has the very similar picture. And again, when we talk about trends, well, this is about as strong as it gets, and that trend will probably continue. I don't see anything here to derail this at this point in time. So now I guess we have to understand what's the impact that this is going to have on the overall market, which leads us in to the topic du jour, which is what really drives the markets. Now, I love this graphic because if I showed you this picture and I said, let's assume that this is the stock market, our global markets, and I said, okay, this little wheel right here, this one right, let me see if I can draw on this piece. I think I can. Come on. This stupid drawing board. I will never get used to this drawing board. I'm trying our hardest to get, there we go. If that one stops working, what happens to the overall mechanism here? The entire thing stops, right? So to me, this is somewhat of a representation of our overall global financial markets. Now, in a watch, like you're looking at here on the screen, this is an inside of a watch with all the different wheels that are spinning and bouncing around. If any one of those stops working, the watch stops working. Now, that doesn't happen in our financial markets. But each one of these wheels, right, that red one I just circled could be the bond market, and the one to its right could be the equity market, and the forex market could be another cog. All of them have an impact on the wheel before. The challenge with trading and investing is those are dynamic. They're going to change. So 1 month we're focusing on inflation, and a year from now we may not even be talking about inflation. We probably will, but the point is that things are going to change. In this watch, everything is constant. So that is a real challenge that I've had over the years, is keeping up with how these specific market segments are moving and influencing one another. This is one of the reasons I love having Scott McCormick of Online Trading Academy on. I think he's one of the sharpest minds out there, and he's always looking at bonds, equities, currencies, and commodities. And the reason for that is their impact. So let me show you something that I like to use as a visual representation, which I call market forces. And in your mind, the people who are watching this, you have the visuals, but those of you listening to the podcast right now, I want you to imagine that you have a steel tube in front of you. It's sitting on the tabletop. Oops, never mind, I'm on the wrong example. I had them switched. So let me talk about market forces. As Big Eb said here, emotions drive markets a lot. Absolutely. I'm going to go off and read off 4 things that, from my perspective, are the major drivers. Number 1 is supply and demand, which, of course, is the cornerstone for all my Trading Academy's educational content. And for me, it's pretty much the cornerstone for anything that we purchase or sell in life. It's based off supply and demand. You may have the most collectible item in the world, but if nobody wants to buy it, it's worthless. So supply and demand, we don't need to dive deeper in that one. Economic data. This is why just about every day I'm going to be talking about GDP numbers, unemployment rates, Empire State manufacturing numbers. Today you had some CPI numbers for global markets. All of that data doesn't necessarily drive the markets. It drives perception of the markets. So as a trader sees a report that comes out today on, let's just say housing data, right? I mean, today, what do we have today? Today didn't have anything huge. You had capacity utilization rate for the U.S. markets. You had industrial production. You had TIC long-term purchases. Those are kind of the big things for the U.S. When a market comes out with that data, that doesn't mean that all of a sudden the market just crashed because we had bad, inventory data. It's people's perception of how that data is going to impact the markets going forward, which is why you should always look at your economic calendar and pay attention to that. Now, number 3 is public perception. And again, I think the economic data by itself doesn't change the markets. It is this piece right here, the public perception, that changes it. And it's not necessarily just public, it's institutional perception as well, right? I guess I could put in here public perception and corporate perception. Now, if you ever watched that video, which I posted here many times, where Jim Cramer basically talks about how you manipulate the markets, you have to understand the corporations are going to try to persuade the public to do something with their money so that the corporations can capitalize on it. It's the nature of the beast, the greater fool theory. Goldman Sachs has far more resources, not just monetarily, but connections in media. On Fox, Bloomberg, CNBC, Washington Post, you name it, they have connections, and they'll be putting stories in there to get you and me to perform a certain action with our money. Now, quite often, it's the opposite of what we should be doing, so be careful with all that news. Public perception is huge in the driver of markets. Now, last piece is manipulation. And I think this is probably the biggest piece here, is the manipulation side of it. We've looked at, since 2009, the Fed has been an unbelievable manipulator of financial markets. They have pretty much basically made this market go nothing but up and up and up and up. So those are my 4 main ones. I could add in a lot more here, but I think that this is what the market forces, or what's driving our markets. Now, here's the example I wanted to go into, which is really just talks about market relationships. So for the viewers, you got a visual. For the listeners, I would encourage you to think of, you have a pipe, like let's say it's a 4-inch pipe in front of you sitting on the table, right? And you can roll it back and forth. And if I ask you to push on the side of this thing and say, all right, I'm gonna push this from the right side and move it to the left, it's gonna roll pretty easily because there's nothing to impede the progress of this tube moving from side to side. However, our markets don't work like this, right? We don't have a frictionless environment for the equity markets. I'll ask you guys, what do you think is influencing the equity markets, right? What are the major drivers here? Well, I think Ron, in his question that he sent in earlier, it's pretty clear that the bond market is one of the major drivers out there. Now, let me just read some data, and of course, oops, that's not what I wanted to see. I'll read some data to you, and it's interesting when you look at the numbers. It can vary depending on where you get the sources from. U.S. equities is estimated to be about $46 trillion of market capitalization. That's that red circle there. So that's that one tube. And for the podcasters, what I did is I now want you to imagine that first tube, which is, let's say, a 4-inch pipe, is now sitting inside an 8-inch pipe. And that pipe is the bond market. So the first one was the stocks, easy to move by itself, but it's never going to be alone. Next is the bond market. Now imagine trying to push the equity markets left or right. It might start a little bit, but it's going to be completely impacted by the bond market. So if I take that stock tube and try to push it, because it's inside the bond markets, meaning the bond's kind of controlling it, it'll start to meet some resistance and not move as far unless the bond markets move. Whereas if I push the bond market tube, let's say left or right, the equity markets are going to spin really quick. Does that make sense, everybody? The relationship, like I can't singularly influence the stock market, but I could have a much greater impact by pushing on that bond market. Now, we take one step back and look even more. Well, now you have the currency market. So now those two tubes are inside another tube, which is a 16-inch pipe. Just for a data perspective, there's roughly $46 trillion worth of value in the stock market, $119 trillion worth of bond market, and $2.4 quadrillion worth of currencies. So the equity markets are so small compared to the global currency markets. And this is why, I've been focusing so much on the dollar lately, just saying, man, if this trend in the dollar continues, just go with that same analogy I was making. Let's say we decide to I want to push on the stock market and make it move. Well, I'm not going to have a lot of luck just pushing the stock market because it's going to hit the bond market, it's going to slow it down, and the currency market will slow it down. But if I decide to push the currency market and get that tube rolling, the bond markets are going to move real easily, the stock market's going to move real easily, and all of a sudden we have tremendous motion in the financial markets. And I think that's where we're at. When you look at what's driving it, these are your main three categories of market movers. But you can't have the currency market, have a big move and have no impact on bonds and stocks. Whereas you could have a big move in the stock market and not really impact the bond or the currency markets, right? And again, I've never seen this in any textbook anywhere. This is me. I came up with this for me to understand the relationships and how it works, and hopefully that will help you. Marcus says, which of the three markets is the least manipulated? Oh. I don't know if that's possible to answer, Margaret. I think that they're all so manipulated. I mean, I could come up with arguments that each one of these is highly manipulated. Now, to get one to move the most, I would say the stock markets are the easiest manipulated because it just doesn't have as much value, right? You could go in there with a lot of money and move a stock market. Bond market becomes much harder, but when you have something like the Federal Reserve, which was out there buying trillions of dollars worth of bonds, well, it's not that hard to manipulate it. I mean, if you look at the yields of the bond market, let's just go back here and let's look at the 10-year, and I'll go to a weekly since 2009, right? So here's your weekly since 2009. Oh, sorry, this goes all the way back to 2000, I'm going way further back, but let's go to the financial crisis, right? At that point, rates were dropped down to zero, and you can see the yields really started to decline. Here in 2018 was interesting because this is when they were starting to unwind the balance sheet, and then they just started piling on and buying more bonds to push the yield down. However, the move we've seen recently is just absolutely incredible from a weekly basis from those 2020 lows, and now all of a sudden yields are surging. So this is, to me, the trapped Fed not really having much choice that they can do here. So they've manipulated the bond market heavily, and then the currency markets, I would say probably the least manipulated is going to be the currency. If I had to answer that one for you, Margaret, I would say currencies. Now, you can manipulate currencies a little bit from an institution perspective, but to organize global manipulation of currencies can be really tough. I think that certainly when we look at manipulation, I guess, are we looking at it as a nefarious act, meaning something that's dubious and kind of an evil act, or just a natural act as a result of something? So, for example, when you have the Fed raise its interest rates, right, as we have been doing aggressively, what is that going to do to the demand for the U.S. dollar? That is manipulation. It's just not necessarily an evil manipulation. It's just a reaction to the Fed raising interest rates is the dollar increasing in value. Why? Because the carry trade. You earn more money by holding U.S. dollars. So, they're all influenced, they're all manipulated, but I would say to have an evil act, currencies would probably be the toughest to manipulate. All right, let me go back to some questions here. I know how do futures come into this being that they touch all three? Yeah, I would put I would put futures if I had to put it in here. Let's just create the graphic. I'll add it in here real quick. Bear with me as I go to this one, and I'm going to create another one. We'll go, and I'm going to put that one right here, and I will shrink that. Bear with me. You'll see it pop up in just a second. I have to just do the graphics first. I'll make that color. What color do you want it to be? We will go yellow, right? So here's what I would say it would look like. It's a yellow one. So it's going to be a little bit bigger than the equity markets because it's, in many cases, your futures are index based. So it's going to be the expectation of where these markets may go in the future. So to me, therein lies a little bit of manipulation. So maybe it shouldn't be as big as it is there, but I would say it's somewhere between stocks and bonds. I would put it as definitely bigger than the stock market, but I wouldn't put futures bigger than bonds personally. Yep, exactly, Chris. Thank you. I am well rested. Yes, we will. We'll talk about Netflix here in just a second. Let's see. And I had some questions I did not get a chance to get to earlier on. Let me get to those. So I'm not going to ignore you, Tom. I was on a roll. What drives the market? I peek behind the curtain, and it's just a bunch of corporate 401k administrators shoving money in. That certainly does have an impact. I mean, you look at portfolio rebalancing. You could argue that earnings seasons also have big manipulation. I mean, there's so many factors that are driving the markets, which I think is why I love it so much. There's so many things to look at. You'll never get bored, and it's never static, right? It's never the same thing. I mean, hell, just the last couple of days. I mean, if you guys were awake last night watching it to 10 o'clock last night or 11 o'clock or midnight, those U.S. equity markets were surging. We're up over 2.5% last night. And then all of a sudden started to get weaker and weaker and weaker. I mean, it's awesome. I love it. All right, let me see what else we got. Big F says, Merlin at the New York Stock Exchange has a market cap of approximately 24 trillion. What percentage of this is institutional money versus retail? Ooh. I would personally, I would say, now do you call a mutual fund institutional? All right, because there's a ton of money in mutual funds. I would probably lean to 60 to 75% would be institutional money, but I don't really have any data on that, so that's an absolute speculation. I could be completely wrong, but I just feel like there's definitely more institutional impact on it than retail. We are generally the lemmings reacting to the advice or guidance of these institutions, and of course they got the money, so they're steering the ship. Let's see. I'm trying to be the 10-year and 2-year on TradeStation phone app, but I don't think we have the correct symbols. There you go, Big Eb. Already got you on that one. Let's see. Joe, I've concluded the only thing that explains why the Fed has acted the way they have is a need to prop up our economy to support maintaining the dollar reserve currency, which is a big yes. So I wouldn't say it's the only thing, Joe. I would definitely say you're on the right path. I would find it completely inconceivable to think that when those board members of the Federal Reserve are getting together going, okay, let's buy $5 trillion worth of bonds, that nobody in that room raised their hand and said, hold on a second, if we pump $5 trillion worth of cash in the market, this is going to have a massive impact down the road. Yet it's not going to impact anything right now in a negative way, right? If you buy $5 trillion of anything right now, it's going to be good for whatever it is that you're buying, right? You know the action. However, there's a consequence to those actions, and that was indeterminate amount of time till we see that. Now, all of a sudden, from those 2009 initial purchases with quantitative easing and 1, 2, and 3 and Operation Twist, and then all the stimulus we got in 2020, that's all now starting to collapse a little bit and come home to roost, so to speak. So I would agree with you that the goal of them, they have a dual mandate, right? Full employment and maintain a stable dollar. That's their mandate, but I think there's a third implied mandate, and that's why the Fed was created, in my opinion, which is, yeah, we want to make sure we have full employment. Yeah, I want to make sure we have stable pricing, keep the dollar relatively constant. But if I have those two things in check, I got nothing else to do. Let's juice the market. Let's juice that market. And Brendan was here. Brendan, one of our regulars, he's always like, don't fight the Fed. Don't fight. And he's 100% right. You should never fight the Fed. At this point, the Fed is contracting money supply, removing money from the equation, and selling bonds. So they're basically telling you markets are going to be going down. Don't fight that Fed. Look for those short rally opportunities. I think I got that. I'd like to hear more about options. Is there a good place you'd recommend? Stocks. I work for my Trading Academy, build content for them, and teach a cryptocurrency program as well. And by the way, if you're interested in cryptos, there's I think a 6-lesson free video or free tutorial in the comment section to this video or any of my TraderMerlin videos. But I would say, Online Trading Academy is a great place. There's a lot of other educators that I'm sure some of our group here might mention. One thing to make sure of stocks is when you see someone who's bragging and boasting specifically about how much money they're making, run away. Run to the hills, leave them alone. If they're posting pictures of all their winning trades all the time online, run away, leave them alone. The real good ones that I've seen, they'll talk about their setups, they'll talk about trades, but they're not going to boast about making tons and tons of money. Usually the ones that are bragging about how much money they make are losers, and the ones who are shut up about it are the ones that are actually doing really well. Let's see. All right. So that was my stance, or what I wanted to just address today from the perspective of what really drives the market. Now, there's a lot of other pieces that are driving these markets, but I think you would be doing yourself a disservice if you made it more complicated than that. I think you really need to keep things as simple as possible. So we focus on the economic data. We focus, even though that's manipulated as well, right? I know you're all going to tell me that economic data is manipulated. I would certainly. It's not just. It's funny. Trader Joe. I'm fine with Brandon Wendell. The one that I can't stand is Sam Seiden. I mean, that guy for years would post all these pictures of, oh, here's a trade you made $6,000. Oh, did you really? I don't recall you actually being in live mode. You can actually see it says simulator on the account. And when the FTC investigated Sam Seiden's trading accounts, it said that he didn't make any money. I mean, I'm reading straight from that. No, I know nothing about Sam's trading, but when you look at the federal investigation against Sam Seiden said he traded very little and he lost $20,000. Yet he's an oracle. He's the greatest out there, so you got to be careful here with. Corey's not with OTA. Corey's with Traders Army. Yep. I would agree with what Tom just posted there. Stocks. Check out some of the videos. Corey Lane is a good one. I like Larry Jacobson as well. I want to get Russ Allen on. Russ Allen he's hard to get on the program. He's always doing so many different things, and he kind of likes to teach and then just disappear for a while. But he's a longtime friend of mine who's an instructor on Trading Academy as well, and he's just great at options. I would encourage anybody to check that one out. Anyway, so that's that. Let's go into what's happening out there today. Unless you, Gary, that's what the lawsuit said. Again, I know nothing about his trading. I always thought he was a great trader, and then you read if the feds had subpoenaed his trading records, because let's be honest, you're never going to know how good of a trader is unless they give you full transparency into every account. One thing I've learned over the years is you can have a trader and they'll open up 5 different accounts, right? And when they ask you, so, well, show me that you're making money, they'll go through and they'll pick whichever account they're making money on. And they might be making money on 1 of 5 accounts and losing on the 4 others. But according to you, looks like they're making money because they showed you that one winning account, which, it's crazy. All right. What happened to Bill Henner? Bill Henner, another great guy. I actually really like Bill Henner. I think Bill Henner went and worked. I think he's doing something with private equity fund. Yeah, I know, Lisa. It's funny. Sam would say that he used to be a trader on the floor of the Chicago Mercantile Exchange, which is an absolute bold-faced lie. He was an order taker. He just took orders. He didn't trade. It's like calling the water boy for the New York Yankees and saying, "Hey, I played for the New York Yankees." No. You were the water boy, dude. You never got on there and played with the Yankees. That's Sam's side. Was Russ an institutional trader? No, I think I don't know, Trader Joe. I think that Russ worked for an accounting firm. I think he's an accountant. So not that he's currently an accountant, but that he was in the past. I think. I don't remember his educational background. All right, let's see. I had a couple of questions. I want to see if I can get to those today. All right, first off, let's dive into what happened to these markets today, because it was a wild one. We talked about the popcorn trade of the day, which was a good one. Man, I did not see this one coming. I actually thought that Netflix would struggle a little bit. It's up 14% right now in after hours. And there you go. Here is Netflix right now. It's trading at 275. It closed at 240. So crazy. So let's go show you the 5-minute time frame. This is a weekly. Here's your 5-minute. There is your after hour pop. I mean, bam. And you know what's crazy about this? If I put this on a 1-minute time frame, think of all these people in that first 60 seconds when they came out with earnings. Look at the tail. It dropped from 240 all the way down to a low of 226. That thing dropped $14 in like 5 seconds. That is insane to think of, like how quickly that thing sold off right there. Amazing move, and then just screamed to the upside. That is the definition of whipsaw. You were like, oh my God, it's going down, I better go short. And somebody got smoked on this thing as it ripped back up, and now is up 14%. So crazy day for Netflix out there. For those that are watching the futures markets, you can see the impact on the NASDAQ that has had. So right here is where that earnings announcement came out, where my cursor is, and you can see just really bringing up the NASDAQ overall. Let's go to the number here. I think this was it. Boom, boom, boom. It came out right after market hours, so that was right about here. You could argue that this is the main impact. It's up 0.9% right now in after hours. So it doesn't seem like a lot, but that's just Netflix, right? Netflix isn't the biggest. It's one of the fangs. Tomorrow you've got another interesting one. Tesla's reporting earnings tomorrow. It's up right now because of this, but keep your eye on Tesla tomorrow. I'll talk about this at the end, but there's a lot of speculation that Elon Musk is going to not make some crazy announcements tomorrow of a share buyback on Tesla. If that happens, you could see this thing soar tomorrow, but we'll really have to wait and see. Yeah, I know they introduced ads. You can pay less on Netflix, but get ads on there, which I'd rather pay more and have no ads, right? I don't want to see no ads. It's annoying. No, Thomasine, I did not see him on Fox Business. Wow, awesome. Well, somebody over there at Barchart has got some connections and helped him out. Yeah, cool, good. John Rowland's a good guy. So let's run through our overall markets just to touch on what happened out there today. Obviously, crude oil was the big downside move here. No real shocker. I mean, the only real thing I don't like about what happened with crude oil is back here on October 6th and 7th, it popped above this area of supply at $90. It hit almost 94 and now is continuing its downtrend. So all in all, still in play to go back and attack these lows right around $76 on crude oil. That was your worst today, down about 3%. Gold, it's just, I really thought we'd see more life out of gold today. So yeah, I didn't really see anything noteworthy out of gold today. It was down 0.49%, but from a technical perspective, it's just a tiny little harami pattern. But it's been harami for 2 days, right? It's a nested harami. I have one call option left. I got rid of 2, and I've just decided to take a flyer and hold one option on Tesla, which is kind of crazy, Big Ab. Yeah, I took a small loss on my other 2. It was actually in good money, but then it just tanked so aggressively. I just kept one of them, which I'm underwater on one contract. I'm down about $3,000 on it, so that'll be an interesting one to see how that pans out for Friday. All right, here's your Dow, up 1.56%, but a lot of this is coming in the after-hour session. I can show you the 5-minute here. You can see, here's your 1 o'clock. All right, this whole move has been after hours. Thank you, Netflix, and some of the others, which I'll show you here in just a second. But most of the major market indexes finishing with nice numbers today. But notice where the NASDAQ was last night. I mean, we were much, much higher last night, and a lot of them gave back some of those gains today. So we'll have to wait and see how it all pans out for tomorrow. Now, here is the earnings calendar for the 18th. You have Netflix, which, look at the beat. They were expected to make 211. They came out at 310. That's a massive beat, of 46% earnings surprise. But look down the list. Only one company on this list missed earnings. That's pretty damn good. And that only one that missed was Hasbro. Apparently nobody buying toys right now, but you had Johnson & Johnson beat, Lockheed Martin beat, Goldman Sachs, Intuitive Surgical, even United Airlines beat on the day. State Street, JB Hunt Transportation, Interactive Brokers, all posting big earnings beats, and all but 2, actually 3, JB Hunt was slightly down, Johnson & Johnson was slightly down, and you had Hasbro was down 2.8%. That was your major earnings announcements, and here is the economic data. So you look at the data, not a lot of critical info here, except for the TIC long-term purchase. That's a pretty big swing. If I remember correctly, this means that foreigners are gobbling up U.S. bonds and equities. I mean, it went from 21 0.4 billion. Expectation was 28.2 billion. A positive number means that more foreigners are buying our bonds and equities than Americans are buying foreign bonds and equities. But look at this jump from 21.4 billion to 197 billion. That's a $170 billion surprise. That is really good for our markets. It shows that global demand for U.S. equities and bonds is surging. So that was a big announcement for the day. And that's going to be it for that. Where are we at time-wise? 35? All right, let me go into a couple listener questions here. This was one that came in from Todd, who you might be here with us today. Todd says, so with the Russell futures at 1640, this was a couple days ago, we're at 1770 now, how does that correspond with the IWM Russell ETF? Seems like the relative support for the IWM is around 163. Why is it that most traders based off the futures activity and not some other chart or basis? Well, yeah, right, Big Eb? Someone got that slightly wrong. They should have known that too. So here you have it. With the ETFs like SPY, QQQ, DIA, IWM, those are tracking a basket of securities, right? They because they're an ETF, they actually hold the securities that are in that ETF. The futures market is speculative. It's speculating on the future. So you're generally going to see price discrepancies between the spot market and the futures market. Now, which one should you use? That's up to you. I mean, I personally like to look at the futures because it's telling me what the industry, what the market, what traders on retail and institutional side are expecting for these markets to do going forward. Where are they going to be? So to answer your question here, and sometimes the numbers can be way off too. Here's the RTY, right? So this is the current future. My guess is this is going to be the December expiration, a continuous contract, but this will be the December one right now. Right now they're expecting 1,771 for the Russell 2000 in December. That's the expectation. That's why it's priced right here. IWM is going to be slightly lower. Now, this just add a zero on it, so it's basically saying that in December, you can expect the IWM to be 20 points higher. Why 20 points higher? Well, because the futures are at 1771. That's the December contract, and currently it's trading at 1750. If you look at the IWM, add a zero on here, 1750. So that's the only correlation there. And you'll see that same thing with things like SPY. So here's your S&P 500, right? Currently the ES is trading at 1758. We go to SPY. Oh yeah, it's gonna be way different. It's the way the calculations are off. I had the Russ, so S&P is at 3758, and right now, if you were to take the SPY and extrapolate the data, it'd be 3710, which means they're expecting the market to be 48 points higher by futures expiration in December. That's kind of how these futures markets work. Now, if you look at the SPX, right, that's the current price, which should be pretty much lockstep with SPY. You can see here SPX is 3719, and I go to SPY. It's 37.11, so just slightly off, it's call it less than 8 points difference there. So SPX and SPY should be identical or very close, and then the S&P futures and the ETFs will be slightly off depending on the expiration of the contract. See some real crystal ball, where do you think the bottom is in equities, and do you think we will hit it? Well, I don't know. I have no clue where the ultimate bottom is going to be. I've looked at this on bigger picture time frames. Go to the monthly here, and I don't know why I have these vertical lines on here. I'll take those off. Do I think we get all the way down to that 217 mark on SPY? I don't think so. I think that we'll probably, the logical spot here is going to go down to 320, which would be 3,200 on the S&P, which would be 500 points lower than where we're at, which is about another 12% decline, 12 or 13% decline. So that's where I'm expecting it to go from here. I'll go out to a weekly so it's a little bit easier to see. But you can see why I chose that 320. It's really this area where it had been bouncing back in late 2020. So that's my expectation, is we will see this drift down and head towards this 320 mark. If you look at my S&P futures here, you can see that I've already got that mapped out. I thought that we would have a bit of a rally up. If you look at the trajectory of this current downtrend, right? I think you guys can all kind of see the basics of how I look at things. You've got an impulse down, small correction up. Another big impulse down, decent correction up. Big impulse down. Now we're going to get a little bit of a correction up, and then we'll have that bigger impulse move to the downside, and I think we'll probably get down to that 32.50 mark. That's where I have mapped out right now. So, and again, I could be completely wrong. Completely wrong on this one, right? It's that's just my idea. I'm one of those people who thinks the trend is your friend till the bend at the end. So go with that trend until it proves you wrong. At this point, the downtrend in the equity markets on all the indexes is pretty pronounced. So let's just keep going with that. All right, let's see. Chris says, okay, so what's this say for upcoming big tech companies if all these companies are beating? It actually speaks volumes of positive actions, and this might be, see, you can have positive things happening on the earnings front because what's been going on is a lot of these companies have been lowering their earnings expectations, right? When you lower your earnings expectations and you beat it, well, you look great, and I think that's what you're going to start to see this earnings season. I was really surprised we didn't get more of a positive reaction last week with the earnings from the financial firms. Now, all of a sudden, we're getting a broader spectrum of earnings with some more retailers, some tech firms coming into play, some pharmaceuticals, and all of it's been pretty positive. So what will happen is you'll get that nice little reaction to these earnings, and then the bigger question is, what do the companies say about their earnings going forward? If they continue to lower their forecast, then I think you'll see the market start to drift down. But that's all conjecture. You have to wait and see kind of what they say about their markets and earnings expectations going forward. All right, last one, and I can wrap things up here. Mike says, before you left, I was expecting ExxonMobil, the old XOM, to fall apart down to about $77. It did shoot up after the earnings preview, and it hit the trend line I have on my chart. I don't have the chart here, but the trend is up and lots of positive outlook, although understandably markets and oil expected to go down. What looks more likely to you, ExxonMobil hitting new highs or reversing for the rest of 2022? Well, here's ExxonMobil on a weekly, and we've drawn this. I'm not sure why I drew this one back here, but let's get rid of that because that triangle is now done. We can go back to some of the discussion we had on yesterday's show talking about zoning. And, if you go at here, you notice that ExxonMobil, for all intents and purposes, is just really stuck on this little range right here. I can tighten it up a little bit, but it's just really range bound. Based off what I'm seeing here, Mark, it looks like ExxonMobil most likely is going to go higher. And you said hit high for the year. Yeah, we're at highs for the year. And the high for the year on ExxonMobil right now is 105.57. You're currently at $100.80. I think it's probably going to make a new high, but then sell off. I don't think it's going to end the year on its high. I think you'll see it break the high. Right now, oil is just soaring. I mean, oil is just where it's at. These companies are killing it on their earnings, and the crude oil chart here. Oop, let me get rid of that little blip. You have had this pullback, so. I don't know much about ExxonMobil's business. I've never been one to study oil companies at all, but right now that trend for oil is still looking pretty decent, even though you've had a significant pullback here and you've got a lot of political tensions going on around the world. Elections coming up, so I think more pressure on these oil companies. Well, we'll see. I do think by that chart of ExxonMobil, you're smacking your head against the ceiling right now. It looks poised for a more of a move upwards. However, you're at supply. So if I were to tweak this and go on a daily basis, I go right there, and I would say that your zone that you should be looking for a potential issue with is that little yellow box right there between 103.40 and 105.66, roughly, are the numbers I'm looking at. And, it's right above us. It feels like the strength is there. It's been making higher lows. It feels like it wants to go higher, but, you're theoretically at a supply zone where you would expect it to go down. So I'm making arguments for both directions, but I do think you'll see ExxonMobil break through those highs and then come back down from there. So there you go, Mike. Hopefully that answered your question. All right, let me real quickly wrap up here and show you what's going on for tomorrow. All right. So here's tomorrow's stuff. Let me get this out of the way, and then we can answer maybe a couple lists of questions. The big one is, of course, your popcorn trade of the day. We had Netflix today, which was a monster mover, still up 14% in the after hours. Tomorrow, it's going to be that one at the top there, Tesla. That's going to be aftermarket close. So much speculation about what they're going to do with Tesla, their earnings, share buybacks. I don't know. It's a crazy one to be in. It's an absolute gamble as far as what happens out there tomorrow, which is why I pretty much close all my position when I got one option left on it. We'll see how that pans out. But you got some big names in there as well. You've got International Business Machines, Procter & Gamble, Lam Research, Kinder Morgan, Abbott Labs, Alcoa, Las Vegas Sands. So, you've got a lot of different sectors. You got pharmaceuticals, you've got consumer staples, resorts, metals. It's a big day tomorrow. Wouldn't have thought that fast. 70 years. And economic-wise, huge day tomorrow. There's so much going on. You probably won't be able to read this because I had to compact it. But you have what I call the Magnum PI day for England tomorrow. That's going to be at about 1:30 in the morning when they come out with their HPI, PPI, CPI, and RPI numbers. For the euro, they're coming out with CPI at 2 in the morning. Canada comes out with CPI at 5:30 in the morning Pacific time. And then down there, the U.S., you can see we've got some big announcements as well. Building permits, housing starts, crude oil inventories, beige book, federal budget balance, and the FOMC member Bullard will be speaking tomorrow. And that's not even all of it. You can look here and say you have the unemployment numbers coming out for Australia as well. So there is a huge amount, not only of earnings interest tomorrow, but you also have a massive amount of economic announcements happening tomorrow. And that Australian dollar, by the way, if you have not been following it, has been absolutely getting crushed. The Aussie just plummeting. It's like, I'm planning my next vacation. I know where I'm going. Let me bring that one up for you real quick. Here you go. Here's the Australian dollar. If you go back to August 12th, it was trading at about 0.71, and now it's at 0.63. That may not seem like a lot, but for a currency, again, that is a huge slide. You're down almost 12% for a currency of an entire country in the better part of just 2 months. That is a big decline, and you notice where it was just a few months back. If I go back here to the highs that we saw back in April, right? So now we're looking at 6-7 months. You're down almost 18% for the Australian dollar. So anybody want to go to Australia? Now is the time to go. Why the 20? Let's see. Why am I missing stuff? October is some huge drops, but in the last 70 years, it's actually positive, even though, yep, exactly. There's only 1 month that's negative, and that is September. However, the biggest drops in the financial markets happen in October, but the month is actually a positive month. And it's not a huge positive month, but it is a positive month. So someone's been reading that Trader's Almanac, huh? Yeah, Trader's Almanac is such a good book. I love it. I should probably try to get him back on the program. I'm really bad at getting guests on the program because I hate asking people to come on the show because it just inconveniences them. There's no monetary benefit. So if you wonder why I don't have guests on all the time, that's why. So the EU markets have been pushing up futures, wondering if their CPI is hot. I think it's going to be hot. I'm just looking at the prices while I was over there. It was crazy. It was really, really just very high prices. Even though the euro was weak, prices were really high. All right, that's going to do it for me for today, everybody. I hope you enjoyed that one, talking about what really drives the markets. For some of you who might be new, hopefully that opened your eyes a little bit to the mechanics, the macro of how all that watch that we call the financial markets function. If you liked it, you can give me a little thumbs up. You can leave comments, questions, feedback below. Any YouTube video, I will check those out and put them into the slides as I did today. Ron from Las Vegas, thank you for your question. You steered the topic today. Maybe tomorrow will be your chance. So send me in a question or a topic you'd like to cover, and I will do my best to get that as a program for us here on the Trader Merlin Show. That said, thank you guys so much. Hope you have a fantastic remainder of your day, and I will see you all on our Wednesday show. Take care, everybody.